Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert Jack Krupey. Now, Jack has been investing in both real estate and distressed debt since 2001. An entrepreneur by nature, Jack decided to start JK Asset Management to focus on alternative assets such as value-add multifamily real estate. He then launched a diversified real estate fund in September of 2020 and just launched a second diversified fund. Jack specializes in tax-efficient real estate syndications and other alternative investment vehicles. Now, in addition to his real estate investment activities, Jack is also the host of the Alternative Investor Mastermind podcast. And so, guys, with that, it's an honor to welcome Jack Krupey to the show. Jack, how you doing today?
Doing great. Thanks for having me.
Yeah, absolutely. Excited to have you here. Excited to, pull back the curtain and learn a little bit more about you and your background. I know before we started recording here, we were just chatting about that background, your Wall Street, history, and ultimately what brought you into the world of syndication. So why don't we back up a little bit? Let's, I gave you such a brief introduction there. I know it goes much deeper than that. So maybe help lay the foundation for those folks that aren't familiar with you and your story, and tell us a little bit more about your background, and then ultimately how you found your way into the current world that we're in today in real estate syndication.
Sure. So I actually went up to Rochester, New York for my undergrad, and I was actually thought I was going to go into the IT industry. It was the late 90s. I was fascinated with the internet. It was a booming time. And, fast forward to 2001, I graduated right in the middle of the dot-com crisis. So went from being flown all over the country with multiple job offers to luckily I had a job, but it wasn't quite as exciting as I was expecting the industry to be. And I went to Vegas for a weekend and I saw the glitz, the glamour, the money. And I was just saying to myself, like, what I'm doing, like this path is not going to get me that, that financial freedom and that income I was looking for. So at the airport home, I bought one of those books at Hudson News, How to Make $1 Million in Real Estate. It was a prior generation of authors at this point. I think it might've been like Tyler Hicks, but anyway, I read that book cover to cover. It's all the different low money down strategies and just different types of real estate investing. And I got back and I called my college landlord. He'd owned a number of properties in and around Rochester. And 60 days later, I owned a house, almost no money down. And 2 months later, I bought another one. And within a year, I'd quit my job and got my real estate license and was doing a combination of flipping houses, wholesaling, building up a portfolio of properties, and really just hit the ground running. And got a good start, but it was still Rochester. It wasn't the same money that people were making in Phoenix or Vegas, during that crisis. So fortunately, it didn't crash as badly, but the market just froze. And it was I'm not from Rochester. I'm from outside of New York City and New Jersey. So eventually, I moved back to New York, and I found a private equity fund that was desperate to hire real estate people. They were buying non-performing loans, in some cases for 3 cents on the dollar. There was a portfolio when National City failed. PNC Bank bought National City, and they were selling home equity lines of credit for 3 cents on the dollar in large portfolios. And many of those loans 10 years later paid off in full. So it was probably the trade of a generation. So I learned that business and eventually moved over to a family office. And eventually we partnered with a large private equity fund. And over the course of 2014 through 2020, bought over $3 billion of loans. This was including trades with Fannie Mae, Freddie Mac, Goldman Sachs. And it was an amazing business, but it also, when you have 30,000 loans, it turned into a little bit more corporate business. And eventually the lifestyle and the high cost of living and more importantly, the high taxes, because as a real estate entrepreneur, the first 5 or 10 years, I was used to a very tax efficient lifestyle, and fast forward to, living in New York and paying 50%, it was really, really difficult for me. So that led me to, the start of researching what I do now. I'd started investing passively in other syndications because it was one of the only ways to get some level of tax deferred income in New York City. And eventually I ended up leaving the firm and was fortunate to get bought out by the other partners. So had a windfall of capital and really decided I was just going to invest full time and primarily outside of the stock market. And so was just building a portfolio of syndication investments myself and decided to build a business around it because a lot of my counterparts in New York that had most of their money in Wall Street were trying to figure out how do they make their first syndicated investment? Which operator, which partner do they choose, which market, which category? And I wanted to offer something that provided some diversification, because most investors were going to start with 50 or 100,000 and really only had the ability to pick one deal. And I wanted to open up a platform for those that were just dipping their toe in to have the diversification across multiple deals instead of one deal. And that's primarily what we do now at JKM Investments.
Okay. No, fantastic. I appreciate that background, and just give us a clear picture of your business today, asset classes, markets that you guys are in, and just a general overlay of what it looks like.
Sure. So we were primarily multifamily value add. Our core asset class is that Class B multifamily that was built in, sometime in the 70s or early 80s, that the perfect scenario is a long-term family owner where, it was occupied and stable, but they weren't necessarily renovating units aggressively. They weren't pushing rents. They weren't managing their expenses more efficiently. We also love self-storage. We love mobile home parks. I know you guys have had a lot of success in that asset class. And that's the core of our fund business. We've done a few student housing deals. We have a ground up senior living, but 80% of it is really multifamily value add. And then opportunistically, we'll go into deals in the storage mobile home space. Personally, I dabble in a bunch of other stuff too. I've done ATM machines. I've done oil and gas. So, I have well more than half of my money in our real estate funds, but I do test out some other asset classes as well, just on the personal level, just because I'm a deal junkie. And, it is good to have some diversification, even in the alternatives outside of the kind of the traditional big three.
Yeah. So speaking to alternatives, I mean, you're a prior life. I mean, you were in the distressed debt world. And so talk to me about that. I mean, is there still opportunity there? And do you spend any time or dabble in that space at all anymore?
Sure. That's a great question. I mean, there's still opportunity, but I was primarily on the residential side of the business. So we were buying, I said we bought over 30,000 loans. Mm-hmm. That business to some extent got institutionalized. When we started back in 08, 09, there just wasn't an industry built around. There was never enough non-performing loans to really have an industry. And over a few years, a number of large funds came in, including a couple publicly traded mortgage REITs that were playing in the space. So it's a market you could still invest, but the returns weren't as good as they were in the 2009, 10, 11 when we were buying loans at deep discounts. Mm-hmm. So the industry still exists, and some of this I still dabble, but I'd much rather be a passive investor with another operator at this point. I'm at a point where I'm not trying to rebuild an operationally intensive business, and the mortgage business can be very operationally intensive. I do think there's a ton of opportunity, but the second time around, I don't think it's going to be residential. There's a couple of facts. 40% of homeowners don't have a mortgage. 30% have locked below 4%. So I don't think there's going to be any sort of a real estate crash on the residential side. And that turns into a really bullish scenario for commercial, for multifamily, for mobile home parks, because I just don't think the single family market is going to crash. Certain markets may need to drop 5 or 10%, but there's just no supply.
So do you think there's going to be, given that statement, do you think there's going to be any stress in any of the other real estate asset classes? And if so, which ones?
Yeah, so I certainly, with interest rates moving the way they have over the last year, certain operators who were not prudent with their debt, if there are those that entered with bridge debt and did not have an interest rate cap, or just bought it well too low of a cap rate and just don't execute on their renovations to raise the rent and raise the net operating income to the point where a refinance can support a much higher interest rate. Those are the groups that'll get in trouble. I really think it's mostly execution risk and or those that really bought wrong. Of the deals that we're in, and we're consistently investing every month. So there's a multifamily deal we purchased. We invested in the end of January, just before rates moved, and we've hit our interest rate cap. We had a 3%. The rates needed to go up 3% to hit the cap, and that property hit the cap. There's no short-term cash flow. The property still has more than enough to cover the mortgage payment, the property management, all operation expenses. But unfortunately, that few percent rate increase has taken away the extra that was initially meant for at least some distributions the first year. But the good news is rents are up between 70 and 90% on renovated units. So we expect that deal will still perform very well. We may hold it towards the longer time instead of being a 2-year deal, which a lot of people were in and out so quickly, they're more likely to be those 3 to 5 year holds where you have to just finish your plan, renovate a good majority of the units, and just add value.
Yeah, no, that's a great point. And, I want to speak to, you made a comment about just, those that might be in trouble. It might be more due to, that they chose the wrong debt, or their execution was just completely off on their value add plan. And I wanted to talk about identifying the right sponsors, right? Like when you're going down that road, you're looking at different alternative investments. Give me some key points that you're looking for when you're seeking out a new sponsor to potentially work with.
Sure. We certainly look for sponsors that have experience first. It's not the flashiest marketing. It's an extra bonus if they've been around since 2008. There's a certain level of knowledge you only get from living in that time frame, having those scars. So it's not an absolute requirement, because there's some sponsors, and it's been 13, 14 years. So there's some great sponsors that started after the crash and built mini empires at this point. So experience is number one. Overall, just core values. Those that put their investors first. Those that have had enough success that they're not desperate to do a deal. We're not the group that's going to work with a couple people that just went to a seminar and are trying to put together their first syndicate. Mm-hmm. We're really there to work with the more experienced sponsors, and many of whom on multifamily, especially when you need to raise $15 million in 45 days. I was a bit surprised 2 years ago that somebody will take your phone call if you could raise $500,000 to $1 million. Even for some of the larger sponsors, it's enough of a needle mover that they're willing to work with you. And in some cases, we it's almost like a real estate deal club. There's times where we get better terms because we're writing $500,000 to $1 million checks, and more importantly, we're writing them consistently. It's not even about the one deal. It's some sponsors just know that we're likely to be there every recurring deal for them as well. So they're willing to treat us like a partner because they know, especially if they're on a tight timeline and they need some help at the 11th hour, some other deal falls through, or one of their investors 1031 is not going to work in time, where we're one of the people in their Rolodex that they may call to come in and work together to make sure the deals happen. It's that value add from us to them.
Talk to me about navigating the volatility that's been existing now. I mean, more specifically over like the last 6 to 8 months. It doesn't seem as though I haven't seen personally that seller expectations have necessarily adjusted to that of where the capital markets are going or have gone. And so there's a fairly significant delta there, and just a lot of uncertainty around it all. And so talk to me about how you guys and your groups are buying today, given where rates are at, given that cap rates haven't necessarily adjusted to accordingly to where the interest rates have risen, and again, playing with that delta. What has the business changed? Has the model changed at all? And if so, what does that readaptation look like?
Sure. So it's something that's been the biggest focus for the entire year by far, is just trying to figure out how to navigate this. And we actually did about half the volume last year than we did the year before, just because we're being much more selective and being careful. Cap rates seem to have expanded, but not as much as interest rates have moved. Interest rates are up over 3%. Cap rates maybe have moved 1%, 1.5%. It also depends on the asset class. The heavy value adds always traded at a lower cap rate, just because there was so much upside in the rent growth. So those were always more compressed. Deals that are much more core plus, or that are already mostly stabilized and are just going to be maybe rents are going to go up 3 to 5% just with inflation, but not heavy renovation. Those tended to have wider cap rates to begin with. Mm-hmm. And I think there's just also more conservative deal terms as well. So we're in a few deals that have 62% Fannie Mae debt, 5-year fixed. So we're not seeing it doesn't look like it's going to be a 20 IRR on paper, but it's a solid 14 or solid 15 with immediate cash flow. So mm-hmm. we pivoted to just having a different expectation. There was a point 2 years ago where I would joke, I'm not getting out of bed for less than a 20 IRR, just kidding around. But certainly my mentality has shifted, and we're just being much more careful overall, and investors need to have that expectation at a 60 LTV, you have much lower risk anyway. So it doesn't, you don't deserve a 20 IRR for a 60 LTV in most cases. And then just from a strategy perspective, we actually did a few deals where we finished out other funds that had bought assets in 2021. So one of our largest allocations was actually a true fund of funds deal where we got better terms, and it was more of an institutional fund, and we were at their very end capital call, and 70% of their assets had fixed rate debt, and they bought most of them in 2021 before the run up, and had a value add already happening on many of those. So that was a defensive play. And now we're just being opportunistic. I'm a firm believer in dollar cost averaging. There's a case study from business school about if you put money in the day before the 1929 crash, it would take you 12 years to break even. But if you invested equally 6 months before and 6 months after, you'd be break even in less than 2 years. And I think that is a perfect analogy for multifamily, mobile storage, all the traditional real estate asset classes. Because right now, cap rates have expanded a bit, and those that buy now, if interest rates do turn again closer to the election time, there could be actually some really solid returns. If you're going in thinking it's a 7% interest rate in 2 years and it becomes a 5%, that's going to factor into cap rate compression again. So we're just consistently looking for good opportunities.
Yeah, no, that's, I appreciate that. And talk to me about the, competitive environment or landscape out there. Have you seen some folks kind of, step to the sidelines, or is it equally as competitive? And I guess more specifically, the multifamily space, is it the same amount of competition? Are the big players still in the space? You guys still having, 30, 40 offers, having to put, money hard day one, or has that landscape changed quite a bit?
It's definitely come back down to earth a little bit. I think the era of hard deposits day one in most markets has, I believe, subsided. And a number of our sponsors, again, were in the business long enough. They weren't going to be the top bid 6 months ago. They were being very selective. They might look at 200 deals to win one, and many of them had a pretty significant payroll for in-house acquisitions teams where they're really trying to work the off-market deals and their long-term relationships. So definitely we've heard multiple deals where they bid on something 6 months ago and didn't win, and then the sellers came back 6 months later and ask if the offer is still good, and they say no, that was 6 months ago based on a 2% less interest rate, but here's where we'd be right now. And many sellers don't really need to sell, so some of those deals just are going to sit on the sidelines for a while. But there's been a couple deals that still got done because the sellers that are sophisticated realize that pretty much most buyers are going to be within a point of their model. Everyone's modeling in higher interest rates.
Sure.
Some buyers are a little bit more, if they're okay with 10-year Fannie Mae debt, they're getting a slightly better rate going in. So some buyers may be a few percent higher, but it's a relatively, for an inefficient market, there's certain parts that are efficient, and ultimately everyone's pricing in some level of interest rate that's higher. So we're certainly seeing quality deal flow, and those that are experienced are the market's coming back to them at this point. And some of the newbies that we're chasing and paying the top of the market have been flushed out, or those that need to raise an extra, with loan to values down 5 or 10%, that's an extra, in some cases, an extra $5 million to raise. And that's the difference between being able to put it together through a country club syndicate or the friends and family network, and really, being out of reach for a syndicator that's not super experienced with a really deep base of investors.
Yeah. Talk to me about the base of investors. I mean, have you noticed any, much more skittish behavior, I guess, as far as the current investor base is concerned and their willingness to deploy capital into new opportunities?
Oh, absolutely. And it's, we had our second half of the year was certainly much slower than the first half of the year. And I think people see headlines, there's, if you turn on CNBC, you see the interest rate headlines, you see the housing market headlines, and these asset classes, the mobile home, the storage are so different than the traditional single family housing market. And, I think often if you just take that headline of, housing starts are dropping, some of those headlines, which sound negative, are actually good for our market. So I think it's going to come down to inventory, and there's just not going to be enough single family inventory because many people are not forced sellers. And there still has not been enough housing starts since 2008. So there's a severe shortage of workforce housing. You cannot build an affordable project in almost any market in this country when you factor in the higher construction costs, higher interest rate. It takes a vast amount of tax incentives to really motivate somebody to take the risk to build at this point, and to build something that's affordable versus building a higher end class A type of townhome style community. It's very difficult. And really the only way is for those of us like us to support the kind of repositioning and redevelopment of workforce housing, or affordable, higher quality mobile home parks. It's a solid need for the community. So yeah, investors have been skittish. Everyone asks about interest rates. Everyone asks, and I don't have a crystal ball, but ultimately what I tend to tell investors is that a well-executed business plan that factors in the higher rates, that has a true value add component, whether it's the renovation of units, whether there's 20 vacant pads on a mobile home park community, and you could actually increase the rent roll or the land lease rent roll by bringing in and selling new mobile home units. You need to do something to add value that's not gambling. You're not banking on inflation. You're not banking on anything other than the sweat equity and the ingenuity of making, adding value to a deal. And if those components are there, the deal should be profitable, regardless of whether rates are up or down a point, or any other factors, barring some World War III or whatever else is happening in the world.
Yeah, no, agree with you on that. And I guess leads me to my next question is like, you personally, what are you most excited about in 2023? I mean, like, given the landscape that we laid out a bunch here, right? As far as kind of where things are at today, what our perspective is, but what are you most excited about in 2023?
Yeah, I'm excited that the business seems to have normalized a bit. This is the way, rates were at 5 or 6% for 20 years. This is not a new, having them go up so quickly what was new, but this is closer to the way the market is supposed to be, where it's not so overheated, where the deals, where you're stretching to do deals. And I'm excited that we're at the 2+ year mark, and we're starting to just get overall momentum, and have built our own kind of informal mastermind community at this point, where we've got a core group of people that that share deal flow. We've invested with a few groups where one of my other investors actually said, "Hey, I like this group," and that the best reference you can get is one of my own investors has also invested somewhere else that's had a lot of success, and we're hitting that critical mass, and that with any business, you need that, you have those 10,000 hours or just a certain amount of hours, and eventually that critical mass hits, and it's a combination of building up enough sponsors and deal flow and investors who we've built a track record with. And, I think we're going to be able to consistently grow a quality base of assets with a great group of both operators and investors.
I love it. I love it, Jack. So for those that want to learn more about you and the different offerings that you have, where's the best place to find you?
Sure. Our website is JKM Investments. That's JKAM. It's for JK Asset Management, jkminvestments.com. We're also on Facebook, LinkedIn. We have the podcast, Alternative Investor Mastermind.com, where we talk a bit about multifamily, but it's really all the alternatives. I had an oil and gas guy on. We had an options trader on. It's just really everything that's not Wall Street, and all the different interesting ways to invest outside of the traditional financial system.
Can they get a link to that as well on your website, to the podcast?
Oh yeah, absolutely.
Okay.
Yeah, absolutely. We have everything on there, and we'll certainly put it in the show notes. And we'd love to have you on in the future as well.
Yeah, I'd love to be there. So awesome. Well, Jack, it's been a pleasure having me. I appreciate you coming to the show and sharing all of your valuable insights with us.
Absolutely. It was great.
All righty, guys. That's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care now.